Hello viewers and welcome back to Dukascopy TV. I'm Natalie MacDonald. Up next in the studio to discuss emerging markets, I'm joined by Tim McCarthy, Managing Director of VTB Capital Investment Management. Tim, thank you very much for coming in today.
Pleased to be here.
Now, investing in emerging markets can often help clients diversify their portfolio, but in a year of EM underperformance, as we've seen a lot of this year, what trends have we seen from clients looking to expand into this market?
That's an interesting question. Over the last 10 years, correlations have actually been significant between 0.6 and 0.8 R squared. But in the last year, as developed markets have outperformed, we've seen this correlation drop to actually a negative level. So emerging markets are providing a little bit more diversification. They certainly provide a lot more diversification in terms of a longer term outlook, in terms of the value that you can find in emerging markets. But in the last year, this correlation has changed quite a bit.
Now, US uncertainty has certainly contributed to EM outflows in 2013. Do you anticipate an abatement in this bearish trend? And for you, what could be the key factor in this trend reversal?
This is another interesting question. The US has created a lot of instability in global markets in the last 5 years since the 2008 crisis. First with the subprime crisis, and then with QE expanding the Fed's balance sheet from under $1 trillion to over $4 trillion today. Unwinding of this balance sheet is going to create another, I think, wave of volatility in the future. What I think most people are very worried about these days, not just in developed markets, but also in emerging markets, is tapering. We saw what happened in May 22nd, when Bernanke hinted at tapering. Markets went haywire for a few weeks there. Volatility increased quite a bit. I think we can expect some more of the same in March, which is the consensus time frame for the next round of tapering talks. But I think this time it'll be a little bit more muted in terms of volatility. I think a lot of that is priced into markets. But this will create more volatility in currencies, more volatility in equities and in fixed income, of course. I think yields may back up a bit. US yields may start moving up towards 2.7, 2.8% on the 10-year. At the same time, emerging market currencies have priced in a lot of this volatility. We saw the Indian rupee drop 15% over the last 12 months. The Brazilian real dropped 12%. The Russian ruble dropped 6% year to date. While the Chinese currency has actually remained flat and moved up and actually strengthened a bit, and will probably continue on this strengthening path. So currencies have probably priced in a lot of this expected volatility from tapering, but I think equities probably have already priced in even more of this expected volatility. So I think emerging markets in 2014 have been set up at a very low level for 2014. PEs in emerging markets are very low. Right now we're at about 11.5 to 12.5 PE. In Russia, it's 6. It's one of the cheapest markets in the world. There are reasons for this. There are structural inefficiencies and reforms that need to be accomplished. But I think the outlook for 2014 is in a very nice place.
In your view, are emerging markets managing to negotiate this decoupling theory that we are seeing evidence of in developed market performance, for example?
Yeah, I think, as I mentioned before, I think the correlation has dropped quite a bit between developed and emerging markets. As I mentioned, from 0.8 to 0.6, and now actually slightly negative, depending on the time frame of the correlation study. So yes, to answer your question directly, there is a decoupling going on right now, but not for the right reasons. I think we would all like to see emerging market growth expand beyond the natural resource sectors into providing sort of value-added services, and for these economies to be sort of more functional across the different sectors, not just raw materials exporting. And we don't want to see emerging markets as dependent on the export sectors going forward. They have been perceived to be the high beta plays on global economic growth, and to a certain extent they are, although they're changing dramatically as we speak. I'm really excited about the prospects for emerging markets in the 5 to 10 to 20 year time frame. I think everybody needs to have certain adjusted expectations when they start looking at emerging markets. I think it's really interesting that 75% of the world's landmass is in emerging markets. 87% of the world's population lives in emerging markets. Growth in emerging markets is 3 times faster than growth in developed markets. Although it has slowed down in the last 2 years, it's still 3 times faster overall. So I'm very optimistic because of the fundamentals that support emerging markets from these demographic factors. And then when you start to combine the financial and global economic factors, things like the amount of debt in developed world versus the emerging world, where the average is about 162% debt to GDP ratio for developed markets, while it's about 24% for emerging markets. 10 years ago, that was the other way around. Emerging markets were indebted to the developed world, but now the developed world is indebted to the emerging world, with 75% of the emerging market central banks, 75% of the global reserves held by central banks in emerging market central banks, and 11% of the world's total debt is issued by emerging markets versus 89% for developed markets. So you have a big asset liability mismatch where all the assets are actually owned by emerging markets and all of the debt is issued by developed markets. So this has to curtail future growth for developed markets. This is why I have a very long-term optimistic outlook for emerging markets versus developed markets.
On that note, then, what is your pick really for the emerging market to watch? Recent guests in the studio have tipped Sub-Saharan Africa, for example. Would you agree? Where's your sort of geographical concentration going to be?
Yeah, I don't think that you can sort of make a statement on a major region or even a major country. I think it has to be more focused on certain sectors. And these sectors could be across several countries or regions. I do like energy right now, and I like financials. I think a lot of people might question financials, but because of all the potential volatility coming out of the developed world, and particularly QE and tapering from the US, as this is all unwound, and many people would believe that financials will receive that sort of volatility through comparative multiple transmission. But I see in emerging markets, banking and financial sectors have so much more growth possibility. They have net interest margins that are 2 to 3 times larger than in the net interest margins of the developed world. We have return on equity that is 2 to 3 times higher, yet they're trading at a price to book of 1 or 1.2 or even below, while developed market banks are trading at 1.5 times book with half the ROEs. So the financial sector looks very attractive. South African financials look attractive. Russian financials look even more attractive. And if you broaden the financial circle out to, say, real estate or credit card businesses, there's some real growth stories there that are, I think, underappreciated right now. But energy is also a sector that I like, both in Russia and in other countries in emerging markets. Energy companies right now are trading at 40 to 50% discounts to their own historical valuations on a price to book, EV/EBITDA or PE basis. Yet oil has been one of the commodities that has held firm during this last 5 years, as most other commodities have fallen substantially. So with oil prices between $90 to $110 per barrel, the energy sector, and particularly the Russian energy sector, looks very attractive.
Tim, thank you so much for coming in and sharing your expertise with us today. Thank you. That's all we've got time for right now, but I'll be back shortly with another exclusive interview for you. Goodbye for now.